Question 1. What is the primary purpose of including an inflation protection rider in a long-term care insurance policy? A. To increase the daily benefit amount to match the policyholder's income growth. B. To ensure that the policy benefits increase over time to keep pace with rising healthcare costs. C. To provide additional coverage for home health care services not initially included in the policy. D. To reduce the overall premium cost of the policy over time. Answer: B. To ensure that the policy benefits increase over time to keep pace with rising healthcare costs. Explanation: Inflation protection riders are crucial in long-term care insurance because they help ensure that the benefits provided by the policy will maintain their value in the face of rising healthcare costs, which can significantly increase over time due to inflation. According to the Nevada Insurance Code, specifically within the guidelines surrounding long-term care policies, insurers are encouraged to offer options that can help policyholders maintain adequate coverage against the increasing costs associated with long-term care services. This is particularly important for individuals who may not need care immediately but will rely on these benefits many years later. The other options do not accurately reflect the primary purpose of inflation protection, as they either misrepresent the nature of the rider or relate to aspects that are not its main function. Question 2. Which of the following statements regarding the free look period in long-term care insurance policies in Nevada is accurate? A. The free look period allows policyholders to cancel their policy within 30 days of purchase for a full refund, no questions asked. B. The free look period only applies to policies sold through licensed agents in Nevada. C. The duration of the free look period can be waived if the policyholder is informed of this option during the sale. D. The free look period is a mandatory provision that gives the policyholder the right to review the policy for 10 days after receiving it. Answer: D. The free look period is a mandatory provision that gives the policyholder the right to review the policy for 10 days after receiving it. Explanation: The free look period is an essential consumer protection feature mandated by Nevada's state regulations. It typically allows new policyholders to review their long-term care insurance policy for a specified duration, commonly 10 days, during which they can decide to cancel the policy and receive a full refund of their premiums. This provision is designed to protect consumers by giving them time to ensure the policy meets their needs without financial risk. Options A and B provide misleading information about the duration and application of the free look period. Option C is incorrect because the duration cannot be waived once mandated by state law. The accurate description in option D emphasizes the policyholder's right to evaluate their purchase carefully. Question 3, scenario-based. Mr. Thompson is considering purchasing a long-term care insurance policy. He is particularly concerned about how he will manage his healthcare expenses if he requires assistance in the future. He has heard about various policies with different daily benefit amounts and benefit periods. He is unsure how to choose the right plan for his needs. What should Mr. Thompson prioritize when evaluating his options? A. The maximum daily benefit amount, regardless of other factors. B. The policy's benefit period in relation to the expected duration of care and overall healthcare costs. C. The number of policy riders included, without regard to their relevance. D. The insurance company's reputation alone, as all policies are similar in coverage. Answer: B. The policy's benefit period in relation to the expected duration of care and overall healthcare costs. Explanation: When evaluating long-term care insurance options, Mr. Thompson should prioritize the policy's benefit period, which refers to how long the insurer will pay for care once the benefits are triggered. Understanding the expected duration of care is vital because it directly impacts how long he will need financial assistance. The benefit period should align with potential future care needs and overall healthcare costs, as long-term care can be extensive and expensive. Choosing a policy based solely on the maximum daily benefit, option A, may lead to insufficient overall coverage if the benefit period is too short. Option C suggests focusing on the number of riders rather than their relevance, which can lead to unnecessary expenses. Finally, option D incorrectly assumes that all policies provide the same coverage. In reality, the terms and conditions can vary significantly. Evaluating the benefit period helps ensure that Mr. Thompson makes an informed choice that adequately addresses his potential future needs. Question 4. In long-term care insurance, what is the purpose of the elimination period? A. It defines the maximum duration for which benefits will be paid under the policy. B. It is the waiting period before benefits begin after the policyholder has been deemed eligible for care. C. It allows for an increase in premiums after a specified time. D. It requires policyholders to provide a medical exam before coverage is granted. Answer: B. It is the waiting period before benefits begin after the policyholder has been deemed eligible for care. Explanation: the elimination period, also known as the waiting period, is a specified time frame that begins when a policyholder becomes eligible for benefits. During this period, no benefits are paid out, which can range from 30 days to several months depending on the policy. This concept allows insurers to manage risk and reduce the likelihood of immediate claims after a policy is purchased. Understanding this period is essential because it can impact the overall financial planning of the policyholder, especially if they expect to need care soon after purchasing the policy. Option A incorrectly describes it as the maximum duration of benefits, while option C misrepresents the nature of the elimination period, and option D is unrelated, as medical exams are not universally required. Question 5. Which of the following is an important factor to consider when assessing the financial impact of long-term care insurance on a policyholder's overall financial plan? A. The policyholder's age at the time of application. B. The anticipated future value of the policy's benefits relative to expected healthcare costs. C. The historical performance of the insurance company's stock. D. The length of the policy's free look period. Answer: B. The anticipated future value of the policy's benefits relative to expected healthcare costs. Explanation: when evaluating the financial impact of long-term care insurance, it's critical to consider how the policy's benefits will hold up against the expected increase in healthcare costs over time. This involves analyzing both the daily benefit amount and the presence of inflation protection riders. If the anticipated healthcare costs rise significantly due to inflation or other factors, a policy with inadequate benefits may not cover the necessary care. While the age of the policyholder, option A, can influence premiums, it does not directly address the ongoing financial implications. Option C is irrelevant as the performance of the insurance company's stock is not a direct indicator of the adequacy of the policy's benefits. Option D, while important, does not impact the long-term financial strategy. Question 6. Which of the following actions is an insurance agent legally required to take when discussing long-term care insurance options with a potential client? A. Provide detailed information about the agent's commissions from different policies. B. Conduct a thorough needs assessment and explain the various policy options available. C. Recommend the policy with the highest premium to maximize their commission. D. Disregard the client's financial situation as it is irrelevant to the insurance offered. Answer: B. Conduct a thorough needs assessment and explain the various policy options available. Explanation: insurance agents are obligated to act in the best interests of their clients, which includes conducting a thorough needs assessment to ensure the recommended long-term care insurance policy aligns with the client's financial and health needs. This is mandated by the Nevada Insurance Code, which emphasizes the importance of ethical practices in sales. Providing information about commissions, option A, is not a legal requirement and may not be relevant to the client's decision-making process. Option C reflects unethical behavior and is not permissible. Option D is misleading, as understanding a client's financial situation is crucial for providing appropriate coverage recommendations. Question 7. In the context of Nevada's long-term care insurance regulations, what is a significant consumer protection measure that must be included in all LTC insurance policies? A. Guaranteed renewability of the policy regardless of health changes. B. A waiting period of no more than 60 days for benefits to begin after application. C. Coverage for pre-existing conditions after a set waiting period. D. Comprehensive coverage for all types of long-term care services. And so, a guaranteed renewability of the policy regardless of health changes. Explanation: one of the key consumer protection measures in Nevada long-term care insurance regulations is that policies must include guaranteed renewability. This means that once a policyholder has purchased the insurance, the insurer cannot cancel the policy or refuse to renew it based on the policyholder's health status or claims experience. This feature is essential for providing peace of mind, as health conditions often worsen over time. Options B and C do not represent mandatory provisions within Nevada regulations. Option D is misleading, as not all LTC policies are required to cover every type of long-term care service, and many have specific exclusions and limitations. Question 8. If a long-term care insurance policy includes a non-forfeiture benefit, what does this provision ensure for the policyholder? A. The policy will remain active for the lifetime of the policyholder regardless of payment status. B. If the policyholder stops paying premiums, they will receive a reduced benefit amount or some form of value. C. The premiums paid will be refunded in full if the policyholder does not use the benefits. D. The policyholder is exempt from providing any medical information at the time of claim. Answer: B. If the policyholder stops paying premiums, they will receive a reduced benefit amount or some form of value explanation. Non-forfeiture benefits are critical provisions that protect policyholders by ensuring they retain some value in their long-term care insurance policy even if they stop paying premiums. This might manifest as a reduced benefit amount or a paid-up policy that provides a limited benefit if the policyholder decides to discontinue premium payments. This feature is particularly beneficial for individuals who may face financial difficulties in the future but still wish to have access to some level of coverage. Options A and C are inaccurate as they do not reflect the typical outcomes associated with non-forfeiture benefits. Option D is incorrect since medical information requirements are typically not waived under such provisions. Question 9. Scenario-based. Mrs. Garcia is reviewing her options for long-term care insurance. After detailed consultation with her agent, she learns about various policies that differ in daily benefit amounts, elimination periods, and inflation protection. She is particularly worried about the potential increase in care costs due to inflation. What aspect should she prioritize when selecting a long-term care insurance policy? A. The lowest premium available regardless of benefits offered. B. A policy with a robust inflation protection rider to preserve benefit value. C. A policy that covers only home health care services. D. The reputation of the insurance company without regard to specific policy details. Answer: B. A policy with a robust inflation protection rider to preserve benefit value. Explanation: for Mrs. Garcia, prioritizing a policy with a robust inflation protection rider is crucial given her concerns about rising care costs due to inflation. This rider ensures that her policy's benefits will increase over time, thereby maintaining their purchasing power against future healthcare expenses. It is important to select a policy that not only provides adequate daily benefits but also adjusts for inflation to ensure long-term viability. Option A, while appealing due to cost savings, may lead to insufficient coverage. Option C limits her options by focusing only on home health care and ignoring other essential services. Option D, focusing solely on the insurer's reputation, may overlook the critical features of the actual policy that impact her coverage. Prioritizing inflation protection directly addresses her primary concern about future costs. Question 10. Which of the following statements accurately describes the role of Medicaid in relation to long-term care insurance in Nevada? A. Medicaid pays for long-term care only if the policyholder has exhausted their long-term care insurance benefits. B. Medicaid will reimburse the insurance company for any claims made under a long-term care policy. C. Long-term care insurance is designed to provide benefits that Medicaid does not cover. D. All long-term care policies are required to include a Medicaid waiver clause. Answer A. Medicaid pays for long-term care only if the policyholder has exhausted their long-term care insurance benefits. Explanation: in Nevada, Medicaid serves as a safety net for long-term care costs but generally requires that individuals exhaust their long-term care insurance benefits before they can qualify for Medicaid assistance. This means that individuals should plan their finances in such a way that their long-term care insurance covers as much of their needs as possible before relying on Medicaid. Option B is inaccurate. Medicaid does not reimburse insurance companies for claims. Option C is misleading because while long-term care insurance can cover a range of services that Medicaid does not, it is not specifically designed solely for that purpose. Option D is incorrect as there is no requirement for long-term care policies to include a Medicaid waiver clause. Question 11. When assessing the appropriate daily benefit amount in a long-term care insurance policy, which factor should be considered the most critical? A. The policyholder's current income level. B. The average cost of long-term care services in the policyholder's geographic area. C. The policyholder's age at the time of application. D. The presence of an elimination period. Answer: B. The average cost of long-term care services in the policyholder's geographic area. Explanation: the most critical factor in determining an appropriate daily benefit amount is the average cost of long-term care services in the policyholder's geographic area. This ensures that the benefits provided by the policy will be sufficient to cover the actual costs of care should the need arise. Understanding local costs is crucial for effective financial planning. Option A may influence the affordability of premiums but does not reflect care needs. Option C, while relevant, is not as directly tied to determining coverage requirements. Option D is important for understanding when benefits will begin, but it does not affect the daily benefit amount directly. Question 12. What is one potential ethical dilemma that an insurance agent may face when selling long-term care insurance? A. Offering policies only from the highest paying insurance companies. B. Encouraging clients to buy policies that are more expensive than necessary for their needs. C. Refusing to answer client questions about policy exclusions. D. Providing detailed information about the insurance underwriting process. Answer: B. Encouraging clients to buy policies that are more expensive than necessary for their needs. Explanation: one significant ethical dilemma in the long-term care insurance market is when agents may pressure clients to purchase policies that exceed their actual needs or financial capabilities, primarily for the agent's commission. This practice can harm clients by putting them in financial jeopardy or leading them to select coverage that does not align with their needs. Option: it does not directly relate to ethics, as the focus should be on the client's needs rather than just the insurer's profitability. Option C represents unethical behavior, but the act of refusing to answer questions does not constitute an ethical dilemma on its own. Option D is not an ethical issue, but rather a standard practice in informing clients. Question 13. What is the primary focus of the claims process for long-term care insurance policies? A. To determine whether the policyholder meets the health criteria for eligibility. B. To ensure that the benefits are paid out immediately regardless of documentation. C. To collect necessary documentation and verify that the claim aligns with policy provisions. D. To inform policyholders about their rights to dispute denied claims. Answer: C. To collect necessary documentation and verify that the claim aligns with policy provisions. Explanation: the claims process is primarily focused on gathering the required documentation and ensuring that the claim complies with the terms of the policy. Insurers must validate the claim against the policy's coverage options, benefit amounts, and other provisions before approving payment. Option A, while part of the eligibility review, does not encompass the entire claims process. Option B is misleading, as claims typically require appropriate documentation before benefits are disbursed. Option D, although important, is not the primary focus of the claims process itself, but rather a part of the policyholder's rights. Question 14. In Nevada, what is a potential consequence of failing to disclose pre-existing conditions when applying for long-term care insurance? A. The insurer may increase the premiums after the policy is issued. B. The policy may be rendered void and claims could be denied. C. The policyholder will automatically qualify for a higher daily benefit amount. D. There will be no consequences, as pre-existing conditions do not affect long-term care policies. Answer: B. The policy may be rendered void and claims could be denied. Explanation: failure to disclose pre-existing conditions can have significant repercussions, including the potential for the insurer to void the policy and deny any claims related to those conditions. Full transparency during the application process is essential, as non-disclosure can be viewed as a form of fraud or misrepresentation. Option A is inaccurate because while premiums may change over time, they cannot be increased retroactively based solely on prior conditions. Option C is misleading, as pre-existing conditions do not guarantee higher benefits. Option D is incorrect. Non-disclosure can have serious implications for coverage and claims. Question 15. Which of the following is a common exclusion found in many long-term care insurance policies? A. Care received in a nursing home. B. Care provided by family members. C. Home health care services. D. Respite care for caregivers. Answer: B. Care provided by family members. Explanation: many long-term care insurance policies typically exclude care provided by family members, which is often considered an informal arrangement and not part of professional caregiving services covered under the policy. Understanding these exclusions is critical for potential policyholders to avoid unexpected out-of-pocket costs. Options A, C, and D generally refer to services that are typically covered under long-term care policies, provided they meet the criteria established in the policy provisions. Question 16. How does the concept of underwriting affect the availability and cost of long-term care insurance for applicants? A. Underwriting determines the geographical location where the policy can be sold. B. It assesses the applicant's health status, which can influence premium rates and eligibility for coverage. C. Underwriting sets the daily benefit amount automatically for all applicants. D. It guarantees coverage for everyone who applies, regardless of health history. Answer: B. It assesses the applicant's health status, which can influence premium rates and eligibility for coverage. Explanation. Underwriting is the process insurers use to evaluate the risk of insuring a particular individual. This assessment often involves examining the applicant's health history, current medical conditions, and lifestyle factors, which can significantly impact the availability of coverage and premium rates. Higher health risks typically result in higher premiums or may even lead to denial of coverage. Options and C are incorrect as they do not reflect the purpose of underwriting. Option D is misleading since underwriting may lead to exclusions or higher costs based on health history. Question 17. Which of the following represents a benefit of having a return of premium rider in a long-term care insurance policy? A. It guarantees that premiums will not increase over the life of the policy. B. It allows the policyholder to recover some or all of the premiums paid if they do not use the policy. C. It provides a higher daily benefit amount for care received. D. It waives the elimination period for policyholders over a certain age. Answer. B. It allows the policyholder to recover some or all of the premiums paid if they do not use the policy. Explanation. A return of premium rider is a feature that permits policyholders to receive a refund of premiums paid if they do not file a claim or utilize their long-term care benefits during the policy term. This rider offers a sense of security, as policyholders can recover their financial investment if they do not require care. Option A is inaccurate. While some policies may guarantee stable premiums, it is not inherently related to a return of premium rider. Option C does not directly relate to the rider's purpose, and option D is also unrelated as it addresses a different aspect of coverage. Question 18, scenario-based. Mr. and Mrs. Patel are considering purchasing a long-term care insurance policy. They are both in their 50s and have a family history of chronic illnesses that require extensive care. What is the most important factor they should consider when selecting a policy? A. The total number of riders available with the policy. B. The comprehensive nature of the coverage, including services for chronic illnesses. C. The company's advertising and marketing materials. D. The premium amount without regard for benefits. Answer. B. The comprehensive nature of the coverage, including services for chronic illnesses. Explanation. Given Mr. and Mrs. Patel's family history of chronic illnesses, the most critical factor in their policy selection should be the comprehensive nature of the coverage, particularly in terms of services available for chronic conditions. They should ensure the policy provides adequate benefits for the types of care they might need in the future, such as in-home care, assisted living, or nursing home care. Option A focuses on riders, which, while important, may not address their specific needs as thoroughly as the coverage itself. Option C. The company's marketing materials should not be the primary focus when making such a crucial financial decision. Option D. Considering premium amount without regard for benefits could lead to inadequate coverage and unforeseen expenses. Question 19. What is the typical waiting period before benefits become payable after a long-term care insurance policy is issued? A. 30 days. B. 90 days. C. 180 days. D. There is no waiting period. Answer. B. 90 days. Explanation. Most long-term care insurance policies have a standard waiting or elimination period of around 90 days before benefits are payable. This period is intended to allow policyholders time to evaluate their care needs and ensure they require long-term care before benefits are accessed. While some policies may offer shorter or longer elimination periods, 90 days is a common benchmark. Option A is incorrect as 30 days is generally not long enough for the elimination period. Option C is misleading as 180 days is longer than typical elimination periods. Option D is false as there is almost always a waiting period. Question 20. In Nevada, which of the following statements regarding inflation protection for long-term care insurance policies is true? A. All policies are required to include automatic inflation protection. B. Inflation protection is optional and must be elected by the policyholder. C. Inflation protection only applies to policies issued after a certain date. D. Policies without inflation protection are generally more affordable. Answer. B. Inflation protection is optional and must be elected by the policyholder. Explanation. Inflation protection in long-term care insurance policies is an optional feature that policyholders can choose to include to help ensure that their benefits keep pace with rising costs over time. This option is not automatically included in every policy, so individuals need to assess their needs and decide whether to opt for it. Option is incorrect. There is no requirement for all policies to include this feature. Option C is misleading, as inflation protection can be added to policies regardless of when they were issued. Option D is somewhat true, as policies without inflation protection may be less expensive upfront, but this can lead to insufficient coverage in the future due to inflation. Question 21. Which of the following factors can directly affect the premium cost of a long-term care insurance policy? A. The amount of time the policyholder has been with the insurer. B. The policyholder's overall health at the time of application. C. The type of medical care the policyholder expects to receive. D. The policyholder's marital status. Answer: B. The policyholder's overall health at the time of application. Explanation: the premium cost of a long-term care insurance policy is heavily influenced by the applicant's overall health status at the time of application. Insurers assess health risks to determine how likely it is that the policyholder will need to access benefits in the future. Therefore, individuals in better health are generally offered lower premiums compared to those with significant health issues. Option: it does not directly influence premium costs, rather, premiums are typically established at the outset. Option C may affect coverage needs but does not directly impact premiums. Option D may influence eligibility or pricing in certain situations but is not a primary factor. Question 22. What is a benefit trigger in the context of long-term care insurance? A. A clause that automatically adjusts premiums based on inflation. B. A requirement that must be met for the policyholder to access benefits. C. A period after which coverage is no longer valid. D. The time frame within which a claim must be filed. Answer: B. A requirement that must be met for the policyholder to access benefits. Explanation: a benefit trigger is a condition that must be satisfied for policyholders to access their long-term care benefits. This could include needing assistance with a certain number of daily activities such as bathing, dressing, or eating, or being diagnosed with a cognitive impairment. Understanding the benefit triggers outlined in the policy is crucial for policyholders to know when they can start receiving benefits. Option A refers to a different aspect of policy management. Option C is incorrect, as benefit triggers do not determine the validity of coverage. Option D pertains to claims processing but does not define a benefit trigger. Question 23. What is the primary purpose of a long-term care insurance partnership program in Nevada? A. To limit the benefits available to policyholders. B. To allow policyholders to retain more of their assets when qualifying for Medicaid. C. To reduce the premiums for policyholders who are eligible. D. To restrict the types of long-term care services covered. Answer: B. To allow policyholders to retain more of their assets when qualifying for Medicaid. Explanation: the long-term care insurance partnership program in Nevada is designed to encourage individuals to purchase long-term care insurance by allowing them to retain a greater amount of their assets when applying for Medicaid assistance. This program typically provides asset protection for policyholders who have exhausted their long-term care insurance benefits, ensuring they can qualify for Medicaid without losing all their savings. Option is incorrect, as the partnership program aims to enhance, not limit, benefits. Option C is misleading because it does not directly influence premiums. Option D is false, as the partnership program does not restrict service types but aims to promote insurance coverage. Question 24. Which of the following best describes home and community-based services in the context of long-term care insurance? A. Services provided only in skilled nursing facilities. B. A range of support services delivered in the home or community settings to assist individuals with daily living activities. C. Medical care provided by a hospital or acute care setting. D. Emergency services available for individuals in crisis situations. Answer: B. A range of support services delivered in the home or community settings to assist individuals with daily living activities. Explanation: home and community-based services encompass a variety of non-institutional services aimed at helping individuals remain independent in their own homes or in community settings. These may include assistance with personal care, housekeeping, meal preparation, and transportation. Option: incorrectly limits services to skilled nursing facilities, while options C and D pertain to medical care and emergency situations, respectively, and do not define home and community-based services. Question 25. In Nevada, what is the maximum amount of time a long-term care insurance policy can impose a pre-existing condition exclusion? A. 6 months. B. 12 months. C. 24 months. D. No maximum limit. Answer: B. 12 months. Explanation. In Nevada, long-term care insurance policies can impose a pre-existing condition exclusion for a maximum period of 12 months from the policy's effective date. This means that if an individual requires care for a condition that existed before the policy was issued, the insurer may deny coverage for that condition for up to 1 year. Options and C are incorrect, as the state law sets a limit of 12 months, while option D is not accurate since there is a regulatory limit. Question 26. Which of the following provisions is typically included in a long-term care insurance policy to provide additional coverage for future needs? A. Guaranteed renewable provision. B. Non-cancelable provision. C. Cost of living adjustment COLA rider. D. Elimination period. Answer. C. Cost of living adjustment COLA rider. Explanation. A cost of living adjustment COLA rider is designed to increase the policy's benefits over time to keep pace with inflation. This ensures that the benefits maintain their purchasing power, which is crucial given the rising costs of long-term care services. Option A relates to policy renewability, while option B ensures that premiums cannot increase, and option D refers to the waiting period before benefits start, not an enhancement of coverage. Question 27. What key piece of information must a long-term care insurance policyholder provide when filing a claim? A. Proof of income. B. Documentation of daily activities they cannot perform. C. A statement from their primary care physician regarding their health status. D. Evidence of having paid premiums for the previous year. Answer. B. Documentation of daily activities they cannot perform. Explanation. When filing a claim for long-term care benefits, the policyholder must provide documentation showing that they require assistance with daily activities as defined in their policy, such as bathing, dressing, or eating. This information is essential for determining eligibility for benefits. Options and D are not typically required for claims processing, while option C may be useful but is not always necessary depending on the policy provisions. Question 28. In the context of long-term care insurance, what does the term elimination period refer to? A. The length of time a policyholder must wait before coverage begins. B. The period during which a policyholder can cancel their policy without penalty. C. The duration for which benefits are available once they start. D. The time frame for which premiums are guaranteed to remain stable. Answer A. The length of time a policyholder must wait before coverage begins. Explanation. The elimination period is the waiting time that a policyholder must endure before their long-term care benefits become payable. During this time, the policyholder pays for their care out of pocket. Options B, C, and D do not accurately reflect the definition of an elimination period in long-term care insurance. Question 29. Which of the following is a common reason for denying a long-term care insurance claim? A. The policyholder failed to make timely premium payments. B. The care received was not medically necessary. C. The policyholder did not provide the required documentation. D. All of the above. Answer. D. All of the above. Explanation. All of the listed reasons can result in the denial of a long-term care insurance claim. Failing to pay premiums can lead to policy lapse while receiving care deemed not medically necessary, or failing to provide required documentation can also prevent claims from being honored. It is essential for policyholders to maintain their policy in good standing and ensure they meet the documentation requirements. Question 30. How does a waiver of premium benefit work in long-term care insurance policies? A. It eliminates the need for annual premium payments if the policyholder is in a nursing home. B. It allows the policyholder to adjust their premium payments based on their income. C. It automatically lowers premiums if the policyholder's health improves. D. It refunds premium payments if the policyholder never files a claim. Answer A. It eliminates the need for annual premium payments if the policyholder is in a nursing home. Explanation. A waiver of premium benefit allows the policyholder to stop paying premiums once they are receiving long-term care benefits, typically in a nursing home or similar facility. This feature helps ease the financial burden during a time when expenses may be high. Options B, C, and D do not accurately describe the waiver of premium benefit and do not reflect common provisions in long-term care policies.